Are you getting tax bills higher than you'd like? If you're nearing retirement or already retired, you realize how much taxes can eat away at what you've saved. That's why in today's video, I'm going to be sharing a story of Steve, who I helped save over $58,000 in taxes per year. And in the process, I'm going to expose the hidden tax that could be hurting your portfolio performance. Steve was only about 2 years out from retirement. He had done all the planning on his own up to this point, but he started second guessing if he should be doing something different and decided to schedule a meeting with me. The first thing he said was, I'm getting these big tax bills and I have no idea what's going on. So after hearing his plea for help, I took a look through his most recent tax return. So many questions were going through my head as I looked at line 7 of his 1040. This line representing capital gains was showing an amount of about $350,000. The first question I asked was, can I look at your tax return from the prior year as well? He had it with him. He actually had 7 returns with him. The capital gain amount was about the same. So next I asked, said, did you take a $350,000 larger distribution from your portfolio to fund a boat, an RV, or a second home? No, I haven't taken anything out of the portfolio since I started investing 40 years ago, he said. So at this point, my stomach sank because I had a feeling I knew exactly what was going on. So I asked Steve, did you happen to bring your most recent investment statements? He hands them over to me. It was a bit of a mess. Accounts were everywhere, but I found the one that was causing the trouble. It was an after-tax brokerage account, and it had a balance of about $4 million. Can you guess what the problem was? I'll give you a hint. It's a type of investment that's still used by over 52% of Americans. The problem was he owned mutual funds inside an after-tax account. And the particular ones he owned had high turnover and 0 mandates for tax efficiency. At this point, I didn't know if I could help him, but I did know we needed to figure out how much unrealized capital gains were in the account. First, I did share the news that it's never a good idea to own mutual funds in an after-tax brokerage account because it gives no control over taxes. And at this time, I had my assistant in the room with me. I gave Steve an example to help understand one of the many ways mutual funds are so tax inefficient. So for a moment, let's pretend the 3 of us have each invested $50,000 in a new mutual fund. And the 3 of us are the only investors in this fund. During the year, I decide I want to buy a new car. So I take out my $50,000. Steve and my assistant do nothing. They don't buy, they don't sell. What happens when that mutual fund manager needs to get me my $50,000? Well, he needs to sell Apple, Walmart, Berkshire Hathaway. And because these sales were made within a mutual fund, all 3 of us at the end of the year get a 1099 DIV, showing that capital gain distributions. It also shows dividends paid and realized capital gains. But the point is that I took action. All 3 of us, though, had to pay tax on the capital gain distribution. So Steve's eyes at this point got really big, and he just wanted to know, can you fix it? Possibly. Now, one potential solution is to utilize exchange-traded funds, or ETFs. ETFs are great because their legal structure allows for near 100% tax efficiency. With ETFs, investors are not exposed to the underlying individual securities and instead pay capital gains when the individual ETF is sold. Now, there's a caveat with this, like anything, that when you're buying an ETF, you want to make sure you're doing it from a reputable company like a Charles Schwab or a Vanguard. A company with a history of operating ETFs with zero capital gain distributions by utilizing a strategy called unit creation and redemption mechanisms. The exact process is way beyond the scope of this video, so simply put, due diligence with an eye for tax efficiency needs to be done on the exact ETFs invested in. Now, the second solution I offered Steve was a direct indexing strategy, especially given the large amount of the account. Effectively, we would buy a bunch of individual stocks in specific proportions to track an index, like an S&P 500. I shared this strategy offers even more control than an ETF portfolio. It does come with some downsides, like slightly higher management costs, and there's also tracking error risk, which is really the risk that the strategy performance deviates from the index it was designed to track. So these were two solutions. I still didn't know at this point, though, whether, what we could do. So first we needed to determine if there was an unrealized capital gain within that brokerage account and how much it was. And unfortunately, there was no cost basis information because mutual fund companies were not required by law to track it prior to January 1 of 2012. Lucky us. Now, fortunately, Steve kept meticulous records of all statements since he started buying. We were able to rebuild the transaction history for the funds and ultimately calculate that cost basis. And from here, the taxable gain. Now, before I share the results, I want to educate you for just a moment on what cost basis is and how it works. So you can think of cost basis simply as the dollar amount you've invested in the eyes of the IRS. So for example, if today you invested $100,000 in a mutual fund, your cost basis is $100,000. However, over time things can change. Dividend income, got capital gain distributions, those would increase your cost basis. And then once that cost basis is determined, you simply subtract it from the fund value, and there's your taxable gain, or loss if it's negative. So now on to the results. And when I looked at this, I had to review it, not just once, but 3 times for anomalies, because the results showed that Steve had barely any unrealized capital gain. Even a couple of the mutual funds had unrealized capital losses. What a relief for Steve. Now, ultimately, Steve decided to sell the mutual funds and reinvest into the ETF strategy I discussed earlier. His tax bill went down by about $58,000 that first year, and is projected to have similar tax savings every year from now on. To end, I want to explain the concept of this story, the hidden tax. Most advisors and mutual fund managers never discuss this. The hidden tax is called the tax cost ratio. It can be viewed as a fee that you're paying to own a specific mutual fund, and it can be incredibly expensive. For a high turnover fund, the tax cost ratio can be 2 to 3%. With the higher one's income, the more expensive it gets. Another way you could look at this is, let's imagine that you have the choice between 2 investment options. Option A has a gross return of 10%, and this is inside a brokerage account. with a 2% tax cost ratio. Option B has a gross return of 9% with a 0% tax cost ratio. Which one do you pick? Well, if you want the bragging rights, you should definitely pick A. But in reality, you always want to pick B, the investment with the higher after-tax return. Because at the end of the day, the after-tax return is really all that matters. I hope you found today's video helpful and learned something new. If you did, please give this video a thumbs up or comment below with your question or takeaways. Thanks for watching.